All right, everyone, this morning we are sitting down with the great downtown Josh Brown. Of course, Josh is the co-founder and CEO of Ritholtz Wealth Management, host of The Compound, longtime friend of ours here at Public. Josh, thanks for being here. Busy week.
It's so great to be here. Thank you for having me, JD. Is this audio or video or both?
It's audio and video, because especially for a guest like you, Josh, we want to make sure we bring the information to the people the right way. Perfect. Couldn't be better, honestly.
All right.
I know no hair and makeup for you and me either, but it's like an embarrassment of riches to have a show with someone like you, Josh, because there's so many places we could start. But let's start with the NASDAQ here, hitting all-time highs this week. Nvidia is more than 6% of the NASDAQ 100. That stock alone up 90%. Is Nvidia doing too much of the lifting, the heavy lifting here for the NASDAQ, Josh? What do you think?
You know, this kind of thing cuts in both directions. So the short answer is you would prefer not to have this large of a company be responsible for this much of the mind share of investors, this much of the market cap of the NASDAQ index and a little bit the S&P. But you've got to play with the cards that you're being dealt. The modern market is being dominated by a relatively small handful of incredibly large companies. These are some of the best run, best performing, most innovative, most profitable companies in the history of the world. You can understand why the market is this way, and you can understand why Nvidia is in the position that it's in. It's not as though this defies explanation. You can look back at 500 years of financial history, and you really have to go to like the Dutch East India Company to find something comparable to the dominance, global dominance of something like Apple or Amazon. There are no analogs. So I would prefer if these stocks weren't, 20% of the NASDAQ. I'd rather they were 15 or 10. But again, this is the environment that we're in. I think smart, adaptable investors have learned to navigate and live with that reality. And then I think you've got people that are stuck in the 70s and 80s, that mentality, and they're having trouble. They've been underperforming for 10 years. They have not acclimated. And, we can't worry about them. We have to focus on ourselves.
Josh, are there things to worry about? Let's say you're a younger investor and maybe you haven't been in the game that long, and therefore you haven't really seen either a NASDAQ 100 or an S&P 500 that's so consolidated around these key names. Can you give us a bit of history here? Have we seen this type of consolidation before? And what does that mean for investors to position themselves knowing that so few names are doing so much of the lifting?
Well, I think the main thing that you want to focus on is not how much of the lifting is happening by a few names, but what else is happening. And when you look around the world, you see all-time highs and 52-week highs almost everywhere. Japan is at a 33-year high. Nvidia is not in that index. The Chinese stock market is on fire this year. It does not contain Amazon or Alphabet. Take a look at European financials. EUFN is the ETF. These are banks in Italy, Germany, France. They are not doing AI. These stocks are at 52-week highs. Small caps are up against 2 years worth of resistance. They could break through. Very little AI in the Russell 2000. So if we want to take the position that it only matters what's happening with the 7 largest stocks, I think we're missing the forest for the trees. So I think what we want to do is just say, okay, it's not as if it's only a small handful of stocks going up. Everything is going up. Right now, 68% of the S&P 500's components, most of which are not tech, are above their 200-day moving averages. That's more than 2/3 of the S&P confirming the index's rally. So what else do you want? Historically, that has not been a top. When you have declining participation and you only have 5 stocks going up, that's the end of a bull market. That's what we experienced in 2007. That's what we've experienced at prior important peaks. It's just not the situation right now. So don't overanalyze so much what the top 5 stocks are doing. Focus on the fact that there are breakouts everywhere.
Josh, this week you linked to your buddy Ben Carlson's piece over at Ritholtz about the gambler's fallacy of the stock market. This idea being that there's there's no real predictive power based on anything that happened previously, even if maybe our human nature might be to assume that there is. What do you think investors should keep in mind based off a market that's up 30% or so in the last 52 weeks?
So this is something that statisticians will tell you about the gambler's fallacy. One spin of the roulette wheel, the result will be independent of whatever the prior spin was. And the same with flipping a coin. If you flip a coin 5 times and you come up with heads, the 6th time, there's no reason why it has to be tails. Now, over 1,000 coin flips, you are going to see, a little bit more of an even distribution. But so the gambler's fallacy is what they built Las Vegas on. It's this human tendency to think that up leads to down, night leads to day, and that at a certain point, if something keeps going one way for long enough, it has to flip. So a lot of people would look at a year of great gains in the stock market like 2023, and their instinct would tell them, all right, well, we had 50% returns in the NASDAQ, 25% returns in the S&P. We're probably going to give some of it back next year. It's just not the way markets work. Markets tend to trend. The point of Ben's piece was to show that there really is no rhyme or reason as to when you're going to have a down year. There's no 7-year cycle. There's no, there's really just like no way to look at what just happened and say that it in any way is going to inform what will happen in the next year. So I think that was the point of the piece, and I think he made that point really well.
What has most surprised you about the market so far in 2024?
I think the same thing that surprised everyone, which is earnings. So one of the things that I think the bears got the most wrong in this cycle was this idea that companies were going to run out of levers to pull, or that all of a sudden earnings growth would stall out, and that just has not taken place. We are now experiencing some of the fastest earnings growth that we've had in years, and that's happening with relatively slow growing revenue and an economy that's not exactly on fire. When you look at GDP, there's definitely some deceleration, but corporations are not the economy. When you talk about the earnings of the S&P 500, you got to remember, you're talking about 500 of the best companies on earth. This is like saying the average basketball player scores 12 points in a game. NBA players are not the average basketball player. The S&P 500 is the NBA. So drawing this distinction between the companies that make up the stock market versus all companies or the whole American economy or the global economy becomes really important. So I think what most people got surprised by, myself included, we had 3 straight quarters of an earnings recession. And then in the 4th quarter, earnings bottomed and started to turn higher. And they are growing faster than most people thought they could. Our companies are just incredible at finding new ways to forge ahead with profitability. This is the hallmark of American style capitalism, whether it's layoffs or it's efficiencies from technology or whatever the case may be, taking price. We just continue to find new ways to surprise to the upside. And I think that's the thing that people are still surprised about.
Josh, I'd love to get you to weigh in a bit because we know that how important this is to our viewers and listeners here at Public. The trend of GLP-1 drugs, the Mounjaros, the Ozempics of the world. We're seeing Hims roll out their own copycat. You see this space more as opportunity or overhype, especially through names like Novo and Eli?
So, I mean, those stocks have already had huge moves. So it's hard to say that. One of the things that people need to learn about the stock market in their formative years of investing is not thinking linearly. Everybody already understands that this is a revolution. So you're not buying discounted companies in the space. These are stocks that are more than discounting an entire revolution in healthcare already. So if you're buying things after the news that's driven them up is already well known, then you have to think that you know something even more exciting than the rest of the market already knows. So we have to, I think, teach young investors that by the time you find out about something, it's not that there's no opportunity left, but you are absolutely going over some picked over stories that have more than appreciated in price. So the question now becomes, well, what drug companies will have the next wave of GLP-1 drugs, or do the current valuations in stocks like Lilly fully discount all of the future revenue and profitability? So, I mean, that's going to be on a case by case basis. So I would say that it's a fertile ground to find opportunity, but you should not think that you're discovering America, like, or you're inventing fire. Like,
Yeah.
these
To the
stocks
point of the Dutch East
India
India Company, which you mentioned earlier, talk about found in America, found in New York. I want to ask you, because this happened before we came on this morning, Josh. Macy's this morning warning of a cautious consumer. We heard from the company say the consumer, we believe, will remain under pressure for the balance of the year. How do you, or how should investors approach all these warnings we see, whether it's in the beauty space, in retail? We follow the food services companies, the Tyson Foods, the McDonald's of the world, warning of a pullback in the consumer, the cracks in the consumer we're starting to see.
Yeah, I think what's happening is that these companies have been able to raise prices. Maybe Macy's is not a great example, but in general, a lot of consumer-facing companies have been very successful in the last few years raising prices, and consumers have gone along for that ride. They've been able to some extent, because of excess liquidity that's in their bank accounts from the pandemic and all of the related stimulus. They've also been able to because wages have been rising, especially at the lower income deciles of the distribution. So that's actually been something that has propelled corporate earnings for a few years. And now they're running into a little bit of a wall where they can't raise prices anymore. And consumers are prioritizing in a way that they weren't even a year ago. So that's why I think you're starting to see McDonald's reintroduce a $5 value meal. You're seeing the former CEO and founder of Starbucks yelling at his own company, hey guys, wake up. People can't afford $8 coffees as a daily habit. So you're definitely going to see, we heard Home Depot say average ticket is shrinking and foot traffic is down. So all of these things are related. And what they're all saying is the price increases have to stop right here. They are no longer being absorbed by a consumer who doesn't care. The consumer is now paying attention, reprioritizing his or her monthly spending habits. And some companies are feeling the heat from that. But I think that's not a signal that all of a sudden, we're going off a cliff. I just think that's a normal economy. Prices have gone too far, and now they have to retrace. And that's actually what the Fed is trying to bring about. So I think it's constructive. I think it's good that companies are starting to look at their own internal cost structure in order to deal with that reality. For the last 2 years now, starting with the technology industry, you're seeing layoffs. You're seeing companies that hired too aggressively reevaluate all that they've done to expand. And this is just normal activity. This is what we're supposed to be experiencing. Not everything indicative of some sort of a slowdown or consumer retrenchment. Not every single sign of that automatically means, here comes the recession. So I think some maturity is in order, and let's see where this stuff goes.
You mentioned the Fed, core CPI up 3.6% year over year, the lowest annual rise we've seen in 3 years. Josh, talk to me about your current view on cuts from the Fed this year. I think we got 5 meetings left.
So we don't have forecasts about interest rate cuts. I would not be the person who could tell you definitively when the first interest rate cut will be or how many they'll do this year. I'm not a chief strategist at a brokerage firm. I don't have any edge there. So I don't think it's that interesting, anything that I could say on the topic.
Is it something you think that perhaps financial media as a whole, are we paying too much attention to what the Fed does given the strength of earnings and all these other powerful forces at play?
Yeah, I say this all the time. I wish everyone would just shut the fuck up already with the interest rate stuff. I think it's childish. I mean, just this idea, we're at full employment. If you have a college degree, you're in a labor market with 1.5% unemployment. That effectively is zero unemployment. So what is this urgency for an interest rate cut? I don't understand it. You have the Dow is at 40,000. Why are you screaming about you need an interest rate cut? Are you insane? And for the people yelling about the mortgage rate, the Fed is locking first-time buyers out of buying a home because of an 8% mortgage rate. Well, idiot, what do you think happens when they cut mortgage rates? You think home prices go down? Did you wake up on Mars, or are you from there? So just this whole idea that the Fed needs to do blank in order to accomplish blank, like people are. I feel as though people just they need to stop talking. And I actually hate that we now have a circus every month. There were 12 Fed governors out making speeches contradicting each other. The media covers every sentence of every one of these speeches like it's life or death. And none of that is true. In the 1980s, Alan Greenspan would do a rate cut and then tell you later. Tell you after. You didn't know they would send out a letter. In the 90s, Greenspan would do a rate hike or a rate cut, and that's it. Wouldn't say anything about it. They would just release a statement. He would testify in front of Congress twice a year. This is true. Look it up. And he would speak like Klingon. Nobody had any idea what he would speak like the caterpillar in Alice in Wonderland. Just the most obtuse language, like almost like lulling the audience. Yeah, lulling the audience to sleep with syllogisms and it would be like that was the whole point. You don't need to know what the Fed is doing. Just be quiet. You focus on making the laws, and they'll focus on monetary policy. And let's hope that those two things stay as separate as they need to be. That was the Fed. And then during the financial crisis, Ben Bernanke decided, and I don't think he was wrong, that maybe we should do a press conference so that no one in the media misconstrues what we're doing or why we're doing it. And we could get our own messaging out there about what we're seeing. And I think in that moment, it was helpful. It was more transparency than the Federal Reserve had ever given Wall Street, the banks, the mortgage industry, the real estate industry. People were crying out for, hey, what's going on? And I think the Fed rightfully accommodated. That's 15 years ago. Why are we still doing this? We're actually doing more of it. When the press conferences started after the financial crisis, it was like every other meeting. Now it's every meeting. They convene a room full of financial journalists in Washington and do these Q&As. And it's the same question every time. It's Jay Powell says, we're going to be data dependent. And then a reporter goes, okay, fine, but what are you going to do in 6 months? I told you, when we see the data in 5 months, we'll decide what we're going to do in 6 months. Data dependent. Yeah. But still, like by the end of the year, are you going to cut rates? I told you, data dependent. It's a joke. It's a joke. It needs to stop. Nobody's being helped by it. It's confusing. It's superfluous in every way. So I don't know when they'll do the
follow-up, I got to say. Yeah.
Yeah, I don't know when they'll do the first rate cut. I only hope that people stop talking about it once it happens. That's
fair. And it's not just Powell, right? I mean, suddenly you got all your other Fed governors, your Wallers, your Bostiks, their household names now in the community. So-and-so spoke. So-and-so was seen in public. I think it's cool when Jay Powell goes to fish shows, but separately than that, I agree with you. We put a lot of attention.
I think it's the right intention. I think they want to be transparent. I actually think that in 6 months, there's a chance they could be fighting for their political independence. If Biden loses and Trump wins, I think the first thing on the menu is, why are we letting the Fed control interest rates? So, I understand the existential threats from outside of the Fed and why that might make them want to have the public love them with all this transparency and FaceTime. I just don't think it's helping the investment community. I think it's giving us something artificial to focus on when what we should be focused on is how companies are doing and how investors are interpreting company results.
So let's go back to one of those big names, obviously, a day before they're set to report. We talked about consolidation and concentration from a company like Nvidia. How about customer concentration in Nvidia itself? 40% of the company's revenue, Josh, comes from 4 companies alone: Microsoft, Meta, Amazon, Alphabet. Does that type of customer concentration, even if they're the biggest names, worry you, especially as all of those companies continue to build out their own AI chips?
I'm really glad you asked that question, because I was talking to someone yesterday, and I think that's the biggest risk in the market, that there's an AI air pocket where, NVIDIA is highly dependent on the hyperscalers to continue to build out their cloud operations and continue to buy GPUs and continue to invest. And if one of them decides to pull back on the spending for whatever reason they might have, do the others look at that and say, maybe we should pull back too? And then all of a sudden, NVIDIA has to say, that demand that we thought would materialize in Q4 is actually going to be more of a Q1 story. And, that could lead to a chain reaction of re-ratings downward for some of the largest companies in the market. So if you ask me, like, what is the thing that investors should be most vigilant about? Remember, I talked about the importance of earnings. I would be very vigilant about any signs that the AI spending bonanza is slowing or being pushed off in any way, because it's my experience that if that happens, it might not just be a slowdown. It's the kind of thing that could end up going in reverse. So right now, everyone's making huge AI investments. Everyone's super excited about all the technology, the potential applications. But let's just pause to recognize it looks like a perpetual motion machine. Microsoft raises guidance, raises CapEx. That money is being spent with Nvidia. Nvidia takes those orders and they raise guidance. And it's like at a certain point, if somebody opts off the carousel, it's going to be noticeable. And I think that's probably the biggest risk facing the market right now.
We got time for a couple quick ones. First, Josh, if you were a retail investor who just got a big bonus at work, let's say you got an extra $1,000, what would you invest in it with right now? Where does that $1,000 go?
I think if you're a retail investor, you should be trying to automate as many of those decisions as possible. I really don't think you should be thinking in terms of like, where do I put this $1,000? I really think that what you want to do is decide on a set number every month that you're going to be allocating to your portfolio. And if you're using public, great. I use public. I have money on an automated basis going into my account. If you're working with an advisor, whatever you're doing, the less ongoing decisions you're forcing yourself to make, the better off you'll be. And if you want to be, involved in stocks and crypto and, do some of your own trading, nobody's going to stop you. It's your money. You only live once. But try to automate your savings to the extent that there's a core portfolio being built. There's an equal dollar amount going into your core holdings. They should be ETFs every month. Don't make sudden changes to that just because you're feeling particularly bullish or nervous. Try to be consistent and focus most of your attention on your career, much less attention on speculating or gambling.
Final question. Who won, Kendrick or Drake?
I think you have to give it to Kendrick if it's over. It may not be over. There may be another wave later on, and maybe that'll be something brand new. But I think this is not like most of the great battles historically where it was kind of murky, or, if you lived on the West Coast, you said Pac. If you lived on the East Coast, you said Big. The Jay-Z Nas thing didn't necessarily have a definitive winner. I think if you're just looking at radio play, if you're looking at social media, if you're looking at Spotify and playlists and downloads, I think it's pretty clear that Drake's tracks were bigger tracks. I understand why. I'm actually surprised. I would not have bet that way at the outset, but the boy did his thing. I don't know what else you could say. It just wasn't enough. So, Drake came with something that he wasn't ready for. One thing that I think is worth pointing out is while this has been simmering for 10 years, with a lot of subliminals and a lot of shade. Drake kind of picked the starting point. Kendrick kind of picked the starting point with his appearance on the Future record. And Drake should have thought, wait a minute, this guy did not start this without something in the tuck. Like, he has to have a few tracks built up that he's going to drop on me. And he did that, and it doesn't appear as though Drake anticipated it. So that 1-2 punch that Kendrick came in with, I think 2 tracks released 24 hours apart from each other and perfectly timed for the weekend. And that was just like very, very hard to come back from. And I think that's why you saw Drake pivot to, all right, summer vibes from now on.
Summer vibes. Back to what's working. Honestly, my take, I think J. Cole's the winner. My man just sat out. He's like, I want none of this. And I think he's been hanging.
Yeah, but his career might be over.
Yeah, we'll see. It's a good one.
J. Cole's brand was boasting about how great he is, and I don't think he can go back to that. So I know he has a new record called The Fall Off coming out at some point later this year. And maybe this will be fuel for what he wants to talk about on that record. But it almost seems like the next thing he's going to announce is, here's my last album and I'm retired. I don't know. So he might look like a winner short term because he didn't get torn apart. But I think he probably is. It's very hard to be a vocal J. Cole fan right now. Is what I would say. So
fair. At least we all got new music out of it for whatever it's worth.
One thing I would say is the best thing that could have happened to Drake was this Diddy stuff. It's horrific, obviously, but like, it's the only thing that could have knocked Kendrick versus Drake off the front page of the internet. So I think this gives him a moment to just, stop and let everything fade a little bit and plot his next move. So I think he finally got a relief.
I had no doubt you'd have a good take on everything from Nvidia to the Fed, as well as Kendrick Drake. Josh Brown, co-founder, CEO, Ritholtz Wealth Management, downtown. Thanks for being here.
JD, you do a great job. Thanks for having me.
Thanks, brother.